Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial, and today I wanted to talk just for a moment about the reporting that surrounds Tesla. We just don't seem to be able to get unbiased reporting with this company, and I want to talk about what's likely going to happen with Tesla's next earnings. I do kind of expect another little bit of a decline with Tesla. This does not affect my long-term view on this company. I have been a Tesla bull for quite some time. I have not made it a secret on this channel, though, that I do hold quite a bit of Tesla stock, and it has made me quite a bit of money over the years. So, of course, I am not in any way unbiased. I am a fan of the company, if not always a fan of Elon Musk himself due to his antics, but that's another subject. So let's talk about earnings and let's talk about some of the headlines recently that came out. And we'll talk about why those headlines really aren't put into perspective at all. And they're really just designed to get some clicks. And no one's really doing the analysis here. Even though there's a lot of numbers thrown into these articles, they aren't really all that significant. And I'm going to talk about why with my second slide here. So Tesla earnings are likely to drop, which is entirely true. And a price war has consequences, which is also entirely true. But it doesn't have the consequences for Tesla that it does for all of the other companies in the EV space. And I'm going to get to that. So, electric vehicle leader Tesla is expected to report lower earnings on higher sales Wednesday evening after the electric vehicle maker slashed prices again to draw in buyers. Once again, all entirely true. But also, like I said, it's not going to affect the profits of this company like it is everyone else. The EV war with traditional automakers spending billions to catch Tesla has morphed into a price war, and the car maker's quarterly earnings will likely help investors figure out who is winning. I'm going to tell you right now, it's Tesla, and the next article is going to show that. So Wall Street is looking for per share earnings of about 85 cents per share from 23.7 billion in sales for Tesla, according to FactSet. A year ago, Tesla reported $1.07 a share from about 18.8 billion in sales. Tesla's price cut significantly. They cut their prices for their vehicles in January to lower price pressures, and that's going to pressure profitability. The EV maker cut prices for some of its vehicles again on Tuesday. The price of a Model 3 rear-wheel drive was cut by $2,000 to $39,990. Well, Tesla doesn't have a ton of competition in this space in the United States yet, although it is growing. And I do think this is actually a positive sign for the industry in general. This article goes on to note that Tesla stock is down 2.8% in early trading, and it seems to be a reaction to the latest price cuts, and that could be entirely true. The real meat here is that analysts project that first quarter automotive gross profits are going to be just north of 20%, down from roughly 25% in fourth quarter of 2022 and more than 30% in first quarter of 2022. So if you're a follower of Tesla, of course, you all know what is going on with that. There's massive cash burn last year getting Gigafactory Austin up and running. Production has scaled in for that facility, and now we're starting to see that really sort of pay off in terms of the number of vehicles that Tesla is producing here. So most analysts, though, still have price targets right around the $275 mark. And this one Canaccord analyst, George Giannakouros, projects that automotive gross profit margins for the first quarter and full year of 2025 are going to be 20.5% and 20.7% respectively, although price cuts create an earnings nail biter. I don't think there's going to be an earnings nail biter. Margins north of 20% are not common in the auto industry. And let's talk about Tesla's margins in comparison to everyone else. So this is an article that's over on visualcapitalist.com. It showed up on a number of different websites that are associated with the EV industry, but never really hit the mainstream news. And this is charted Tesla's unrivaled profit margins. All right. So net profit margin per vehicle. Tesla's grip over the EV market is gradually slipping, but recent data shows that the company's private market profit margins are simply unrivaled. And folks, that is absolutely true. Their profit margin per vehicle averages, after not these price cuts today, but the price cuts back in January, averaged $9,574 per vehicle. Now let's compare that to the rest of the industry. GM's profit margin per vehicle is roughly $2,150. BYD, which would probably be considered their biggest threat in China, their profit margin per vehicle is $1,550. Toyota's is 1,197. Volkswagen is 973. Hyundai is 927. Ford is losing $762 per vehicle. Xpeng is losing $11,735 per vehicle, and NIO at $19,141. Now, each one of these companies, of course, is at a different stage in their commercial development and the development of EVs. But what they haven't done, that Tesla has done, is to rethink the manufacturing process for vehicles from the ground up with efficiency in mind. So GM, Toyota, to some extent BYD, Volkswagen, Hyundai, and Ford, they all face the problem of having sunken cost in their current manufacturing process, meaning they're doing things the way they do things because that's the way they've done them in the past. And it would cost a lot to change those processes at this time. So they are looking to do that, though. One of the reasons, actually, not the or not one of the reasons, but the main reason that GM, BYD, Toyota, Volkswagen, Hyundai, Ford, all these companies are getting into the EV space is because of Tesla's margins. And they started this process really back in 2019 when they started to see the profit margin on the Model 3. The reason that EVs are going to dominate the car market in the future doesn't have as much to do with going green as people think, doesn't have as much to do with efficiency as people think. There are things that are already more efficient than the internal combustion engine. It has everything to do with manufacturing profit margins for these vehicles. Tesla is absolutely kicking butt in terms of how much money they're making per vehicle, and that is not going to change anytime soon. So I think that it is obvious that this is realized by the auto industry. This is realized by people in the mainstream media who report on this. This is just not something that's very exciting for a topic for people to talk about, which is how Tesla has rethought manufacturing from the ground up, has taken a lot of cost out of the vehicle, continues to create efficiencies in the manufacturing process, and continues to benefit from Wright's Law, which is basically a manufacturing concept that says the more you start producing something, the better you get at it and the more efficient you are. So roughly for every cumulative doubling of manufacturing of any product in the auto space, you get about 15% more efficient. So Tesla's profit margins per vehicle outside of price cuts are actually going to grow and grow and grow. They're still producing, maybe this year they hit about 2 million vehicles, whereas GM is making about 7 million or so. Volkswagen is making about 10 million vehicles. They have a lot more volume and they still have lower margins. And a lot of that, like I said, is that sunken cost in their current manufacturing processes. They are going to be forced to invest billions and billions of dollars, the money that Tesla has already invested in these new manufacturing processes. And it's actually going to take them a long time to catch up in terms of profit margins. Whereas Tesla will gradually improve over time. And they're also going to introduce new projects. They're branching off into new areas. They're creating new revenue sources and that sort of thing. Anyway, folks, just my quick thoughts today on Tesla and the earnings that they're going to report either, I think it may be even as early as today. But anyway, thank you very much for watching today. I hope that you enjoyed this. I hope that I prepared you for a price drop with Tesla. And then in terms of my long-term view on the profitability of Tesla and the future of this enterprise, it remains unchanged. I think that it's going to be one of the largest components of the S&P 500 going forward. It already is, but I think it's going to be in a battle for the largest component of the S&P 500 with one other company. And I think it's going to happen in less than 10 years. Anyway, thank you very much. Have a nice day, and I'll see you next time.